Hello everyone, and welcome to this one, the latest in our series of irregular podcasts. My name is Gabriel Stein. I'm Director Asset Management Services at Oxford Economics, and I have with me, at least her voice, Kathy Bostjancic, who is based in New York and who is head of our US Macro Investor Services. And we're going to discuss the pros and cons of the Federal Reserve's monetary policy, specifically when is the Fed going to start normalizing interest rates. And the Oxford Economics main forecast is that the first move will come in December. Kathy, do you want to talk a little bit about that?
Yes, sure. Thanks, Gabrielle. Yeah, so I think it's also worth noting that before the last month's developments, where we had wild gyrations in the financial markets, another downdraft in commodity prices, increased concerns about China's slowdown and an emerging market, a more broader emerging market slowdown, we actually had been expecting a September rate liftoff from the Fed. We felt that the domestic conditions certainly seemed to argue for that. The labor market was continuing to strengthen, the excess slack was diminishing in a very nice fashion, and we also saw that the output gap, GDP growth, all seemed to be moving in the right direction. Kind of the thorn in the Fed's side, though, is the other dual mandate is the inflation rate. That has continued to kind of plague and be on the low side of readings, and I think in light of the latest month action, financial market instability, financial market tightening, and again with commodity prices going further south, and we made the decision that they're probably going to wait now at this point. So instead of going in September, we've pushed off our rate liftoff to December. So just in terms of the people who like odds, we assign a 45% chance of them starting the liftoff in December. September we've lowered to 20%. October, it's a chance, small one, but we put it 10% simply because it's not one of the big quarterly meetings where there's a press conference and new forecasts released. And then the remaining 25%, we think, if things don't play out over the next few months, they could even wait to start liftoff into 2016. I think particularly it's the dovish members of the FOMC who are not going to be quite ready to pull the trigger and actually going to be a bit cautious given what we've seen over the last month. Some of the hawks we've heard from, and maybe previously weren't even so much hawks, but now by default become more hawkish, is Vice Chair Fisher of the FOMC, Bill Dudley from the New York Fed Reserve, and also President Williams from the San Francisco Fed have all left the door open to September, so it's not zero. But they didn't make the real hard case that, yes, we're preparing to raise rates. And I think that's another really key point to make here, Gabrielle, before I hand back to you, is that I think they would have preferred that the market was very highly pricing in the odds of a rate move before they actually moved, meaning that they would telegraph it so much we would know they were about to move rates, and we wouldn't be having this discussion or podcast right now. The fact that the odds right now, the market's only pricing in 28% probability for next week is another reason I think they end up delaying it. I think they use this statement in the post-press statement by Yellen to try to prep the markets for a December rate hike.
Now, okay, so there are a lot of things that one can say there, and I should perhaps come clear here and say that my own view is that I think the Fed should have raised rates last year already, symbolically, simply as a signal, and I get the impression that quite a few Fed members feel the same thing, but in a way that's completely meaningless because they didn't. But before I go into other things, isn't it the case that isn't there a danger with your reasoning that the Fed in essence gives markets a veto over monetary policy?
Well, I think the markets wouldn't be pricing in what they have if Fed officials weren't more clear about their intentions. So you had Jackson Hole Symposium about a week and a half ago. Yes, Fisher made the case that at some point, and hopefully this year, they'll be raising rates, and he thinks inflation will rise as the output gap closes. But he really stopped short of saying, and this is going to happen in September. And subsequent Fed speakers since then have really waffled. So the market is largely taking its cue from Fed speakers.
From the wafflers. Okay, well let me play here the devil's advocate and argue the case for September, because to my mind there are a number of reasons, both more principal and perhaps based on indicators, why the Fed should move in September, and I'll list them all, and then obviously you'll get the chance to knock them down again. I think two key reasons would be, first, that an interest rate increase, at least a symbolic one, because let's be quite clear. The real Fed funds rate is negative. It's extremely low by historic standards. If the Fed were to raise interest rates by 100 basis points, 1 full percent, which we're not talking about, the real Fed funds rate would still be extremely low by historic standards. So we're talking about maybe a quarter point hike coming now, or maybe even less. Now, if that were to happen, it seems to me that that would be a very strong statement from the Fed in support of the US economy, saying we believe in the US economy, we think it's strong enough to withstand a normalization of interest rates, and that's why we're beginning that. And from that perspective, it might even boost business and consumer confidence in the States. Now, second, and for all I know elsewhere, a second argument is that by raising interest rates, by starting the process, the Fed would get rid of the uncertainty which has bedeviled markets. And in fact, there is an article on the front page of today's Financial Times which says exactly that, which points out that emerging market central bankers are now asking the Fed, for God's sake, get on with it and raise interest rates so we don't have this discussion. So those are, in a way, more overarching or principled reasons. But then if you look at domestic US data, the labor market is tightening. Unemployment is down to 5.1, 5.2%. If that is not at full employment, then it's very close to. The rate of inflation admittedly is subdued, but as Stanley Fischer pointed out, monetary policy works with long lags. You can't wait until inflation is at target before raising rates. And then if you look at other leading indicators of economic activity, admittedly they are mixed, so I'll be using the ones that support my case here, but business confidence and consumer confidence are healthy. Car sales, a leading indicator of household confidence, not just in what they say, but what households actually do, are surging. The housing market is finally picking up steam. Broad money, and listeners who have heard me before know that I'm a monetarist and take a keen interest in monetary developments. US broad money is growing at 6-7% per annum, between 5 and 7% per annum. That's quite strong by historic standards. Credit to the non-bank private sector, which the Fed thinks is more important than money, is growing even more strongly. If the Fed cannot raise interest rates in this environment, it seems to me, when on earth are they going to do it? So it seems to me that the case for September is actually much stronger than perhaps we are taking account of and markets are taking account of. Now tell me where I'm wrong.
Well, I would actually largely agree with the arguments you've laid out, the reason why they should go in tightening. I just think that the delay from September to December is likely what's going to happen. But I think all of the reasons you've laid out, plus more to add, would argue for a near-term rate increase. And we haven't taken it completely off the table. We've just pushed it back from September to December. We just think politically...
But you also did mention maybe into 2016 if markets remain unsettled and so on.
Well, I think it's in terms of placing odds. We would still see the bulk of the odds. It's coming this year, but I think if we get some further downdraft and the financial markets become unglued, if somehow commodity prices start to feed through more meaningfully to core inflation in the U.S., I think it puts the Fed in a bind. It may very well be that they should have tightened earlier before all of this happened, but they didn't. And now they've got the dovish faction of the FOMC, which, by the way, if you go back to their last set of minutes, even there, the doves were really quite cautious and questioning whether they were really at liftoff yet. Are we prepared? Do we have the conditions? Have they been met? And it was really on the inflation mandate. I think most everyone sort of agrees that a labor market it was looking quite good, and that if the trend continues, you'll be at full employment. But how is that then going to feed through to the inflation side? And it's really continues to be goods prices and commodity prices, and it's even excluding energy that's holding down inflation. I personally think, I wish they would have gone, and I think that the data could have suggested you could still go in September, but I think you look at what they're saying, and you think about the composition of the FOMC, I think it's unlikely. It's not 0%, but it's a low odds. And hopefully if we get financial stability and some data that continue to show the U.S. economy remains sturdy, we'll get that liftoff in December.
Now, I mean, we today, when we record this, it's Thursday, the 10th of September. We will obviously know in a week, so we will see then, and we may or may not have to repeat this podcast later on. But let me bring up another point. You have mentioned in a research briefing, which you are sending out to our clients, I believe, later today, that really what matters isn't so much when the Fed starts, but where the Fed funds rate ends up. And in fact, both you and I have written about this in the past for Oxford Economics clients. The real Fed funds rate, long-term average, is 1.9%. Assuming that the Fed really, that the US inflation really does go to target, 2%, where and when, and I'm asking you to take a punt here, where and when will the Fed funds rate end up, in your view? So we're assuming inflation at 2%. Where will the nominal Fed funds rate be when it peaks?
Yeah. So our equilibrium funds rate projection is 3 3/4, but we think it'll take a number of years before we get there. It won't be until sometime in 2019. The funds rate, we believe, middle short-term interest rates will rise very gradually in line with the output gap closing. And we believe that the Fed will be quite cautious. Interestingly, and I've updated a table that shows where our forecast is versus the Fed's median dot plot estimates, and then what the markets are pricing in. And the markets are even flatter with their trajectory, the path of interest rates, and it takes until 2019 before we get to 2% on the Fed funds rate. So I think that ultimately is what has to be reconciled, right, over the next few years, is where do we end up and how quickly do we get there?
Well, that's interesting, because we know, of course, from the past that in the last two tightening cycles, the Fed has turned out to raise rates faster than the markets expected, but also faster than the Fed expected. For what it's worth, we are far apart on the time, not so far apart on the peak. I would venture to say that peak of the nominal Fed funds rate is more likely to be 3.5, but I think it's going to be reached faster. I think we may well be reached in 2017. The truth is, we will see. And as I said, we will repeat this podcast and discuss this many times. Meanwhile, thank you very much, Kathy, for taking part in this, and to all our listeners, there will be further podcasts to come, and we hope they will be of interest to you as well. Thank you very much.
Thanks, Gabriel.